Chapter 7 Financial Reporting and Changing Prices. International Accounting. International accounting is the accounting that focuses on the related issues to the company who runs the international business. Financial Statement. Financial statement is the record of financial information company at the particular period that can describe the company's performance. Changing prices. To understand what changing prices means, we have to distinguish between the general price movements and specific price movements, because both of them are included with this concept. The general price level generally happens when the price of all goods and services are averagely changing in economy. The increases of price are called inflation, while the decreases called deflation. On the other side, the specific price change happens when the price of goods or service changes along with the ups and downs of demand and supply.
Why the financial statements potential misleading during the changing price period? During the inflation, assets value recorded with its acquisition cost, which is really reflect the current value of that asset. The reduced value of assets cause the understated expenses and overstated income. From the managerial perspective, the inaccuracies of measurement cause the distortion on 1. Financial projection based on the unadjusted historical time series data. 2. Budget become to the basic of measurement. And 3. Failed performances data hold the effect of the uncontrolled inflation. In the inflation period, revenue generally presented in the currency with lower purchasing power or purchasing power of the current period then applies to the related expenses. Expenses presented in currency generally with the higher purchasing power because it usually reflects the consumption of resources that obtained in the past when the monetary unit had more purchasing power. Decreasing expenses based on historical purchasing power from the revenues based on the current purchasing power cause income not measured accurately.
Types of the inflation adjustments. A. General price level adjustments. Number 1. Adjust currency amount to the general price level or purchasing power. Changes are called historical cost constant currency or general purchasing power equivalent. Number 2. Currency amount that haven't been adjusted are called nominal amount. For example, during the period of the rising prices, long-life asset on the balance sheet with its acquisition cost is presented in the nominal currency, when the historical cost allocated to the current income or in the form of depreciation expenses. So, revenue as the indicator of purchasing power adjusts with the expenses that show purchasing power or higher for the latest year when the assets were bought. Therefore, the nominal amount must be adjusted with the general purchasing power change to match with the current transactions. B. Current cost adjustments. Number 1. Assets are valued at the current cost rather than the historical cost. Number 2. Income is defined as the net earning after tax from the company is the amount of the distributed resources by the company during a period, or not included the tax consideration, while still maintaining the production capacity or physical capital. One of the ways maintain the capital is with adjust the first position of company's net assets, or with the specific price index or direct pricing, such as current invoice prices, supplier price list, etc., to reflect the change of current cost equivalent for the asset during the period. C. General price level just with current cost. Number 1. This measurement using both of general and specific price indexes. Number 2. Disclosure of the current cost change from the company's non-monetary assets after deducted by inflation. It's aimed to show the portion of the changing price of non-monetary assets that exceed or less than the change of purchasing power.
Inflation accounting approach in some countries. A. United States. In 1979, FASB issued the Statements of Financial Accounting Standards Number 33 about financial reporting and changing prices. That statement required the companies in U.S. which have inventories and fixed assets before deducting with accumulated depreciations of more than $125 million or have total assets of more than $1 billion to try to reveal both of historical cost constant purchasing power and current cost constant purchasing power for 5 years.
B. England. The England Accounting Standards Committee (ASC) issued the Statement of Standards Accounting Practice Number 16 (SSAP Number 16), Current Cost Accounting. Based on the 3-year experience in March 1980, SSAP Number 16 only adopted the current cost method for external reporting and required both of current cost income statements and balance sheet with explanatory notes. England's standard allowed 3 reporting options. There are 1. Presenting the current cost account as the basic statement equipped with historical cost accounts. 2. Presenting the historical cost accounts as the basic statement equipped with current cost accounts. 3. Presenting only the current cost accounts equipped with the necessary historical cost accounts.
C. Brazil. Recommended inflation accounting in Brazil consisted with 2 reporting options. They are 1. Brazilian corporate law. By representing permanent assets and stockholders' equity accounts using the price index recognized by the federal government as the measurement of local currency devaluation. 2. The Brazil Securities and Exchange Commission. It requires another inflation accounting method for publicly traded companies. Listed companies have to measure all the transactions in current period using functional currencies. At the end of the year, General Price Level Index converts purchasing power unit into nominal currency unit.
International Accounting Standards Board (IASB). The IASB has concluded that financial position reports and operating performance in local currency are useless in the hyperinflationary environment. Specifically, the company financial statements that report in the currency of the hyperinflationary economy, whether based on historical or current costs, must be represented in constant purchasing power as of the balance sheet date. This rule also applies to corresponding figures for the preceding period. Gains or losses of the purchasing power related to the liability position or monetary net assets should be included with net income. Inflation issues. Analysts have to focus on the following issues when read the inflation adjustment report. A. Inflation gains and losses. B. Equity gains and losses. C. Foreign inflation. D. Avoiding the double dip.
No!